Okay, welcome to the February 7th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk about what's going on in the soybean oil market, check in on the crop progress down in South America, talk a little bit about the upcoming WASDE report, and then look at biofuel or biomass-based diesel margins from a couple different perspectives. And then finally, we'll wrap up with a quick preview of the Malaysian Palm Oil Board report that is going to come out on Friday. So let me do this. Okay, so South America. Conditions really are not that different than they have been in Argentina. The weather maps continue to forecast rainfall, and to be fair, they have gotten a couple of significant events, although the problem is the ground is so dry that even if you get an inch of rain, it improves soil moisture a little bit, but temperatures are warm, and so that goes away pretty quickly if it's not followed up by another round of rain. And it looks like that's going to kind of be the theme for the rest of the Argentine growing season. I don't know that we're going to get just a shift to where they get sufficient rain to really rebuild soil moisture levels. And on some level, I mean, that may be too much rain at some point. Although, again, if they get rain while the soybeans are filling pods, then yields can be substantially better than I think expectations are maybe right now. As you can see on the slide, the Buenos Aires Grain Exchange cut their forecast for Argentine soybean production to 41 million tons. That's above our 39 million. But there are projections out there that are below us by, 2, 3, 4, 5 million tons. And that is possible, definitely. If the current pattern sort of continues, I could see that that expectations for the Argentine crop will continue to shrink. Now, one of the things that makes Argentina different than other countries, for sure, is that farmers use soybeans as a hedge against economic uncertainty and the inflation rate down there, which is extraordinary. And so there is a bit of a buffer in stocks that that can be used to cover some of the shortfall in the crop, at least from expectations. I don't think that means that crush forecasts aren't going to come down at all. And obviously, the government has had to incentivize farmers to sell their soybeans, but it may be that the impact ultimately is a little bit less than whatever you would think, just based on if somebody just told you what the production was and you kind of knew the history of Argentine crush. You may estimate a little bit lower. That said, the crop is obviously going to be substantially smaller than the 50 million tons that was predicted earlier in the season. Brazil kind of has sort of not quite the opposite problem. Brazil's crop is still developing really nicely, and CONAB's January report, they estimated the Brazilian crop at 152.7 million tons, which is down just a little bit from their December forecast. It's a little bit above ours, 3 million tons. Where it's sort of the opposite of Argentina, other than they've had a good growing season, is that it continues to rain in Mato Grosso do Sul. And again, while that isn't necessarily going to have a really, really substantial impact on yields, it can delay harvest, and it can cause some problems with soybean rust and other diseases. But I don't think that it is enough to dramatically reduce expectations for Brazilian production. Now, the one area that is at risk is southern Brazil, and Rio Grande do Sul is an important producing area. and CONAB cut their forecast to 20 million tons in January from 22 in December. So expectations for that part of the crop are falling, and I don't know that you can take enough out of Rio Grande do Sul or all the way up to sort of Paraná to really reduce the Brazilian crop. And Brazil's production is going to be 25 million tons more than it was last year. So the shortfall in Argentina really is mostly covered by the increase in Brazilian crop, at least relative to last year, not relative to expectations, but relative to last year. Until or unless the situation improves in Argentina, I think that you probably are going to, one, have a floor under soybean prices. It looks like $15 is a pretty hard floor there. But two, you're going to, I think, also support meal prices. And I think part of the reason that we've seen such strength in meal over the past, I don't know, month and a half or so, is because there are concerns about Argentine production, Argentine soybean meal exports falling, and US exports needing to make up the difference. Now, if you had said that 6 months ago, I think I would have said, well, that'll be great because the US is going to crush so much, or the US soybean crush is going to increase so much because of the feedstock demand for biofuel that we're going to need to find a place to put the soybean meal. And I still hold that view in the long term. However, what we've seen in domestic soybean meal demand is just month after month of record usage, if you look at it on a use per day, average daily use basis. And so I think the surprising part has been the strength of the domestic market, and that has left less exportable surplus than I think the market expected. And so you've had meal prices run up to nearly $500. And that increase in meal has also weighed on soybean oil prices because specs and other market participants will take a short oil share position. And so as they buy meal, they tend to sell soybean oil. Now, while that has weighed on soybean oil prices, at least in the futures market recently, I think what today's price movement shows is what happens when the tide starts to turn the other way, and those traders need to start covering those short oil positions. So I think that there is a combination of events that sort of triggers a mass liquidation of that short oil position, and traders start to build a long oil share position. And that is something that, again, per today's movement, can have a significant impact on soybean oil prices and drive them higher really quickly. Now, that scenario, I think, is probably really low probability. You have to have sort of several things kind of fall into line for that to happen, including kind of a significant improvement in Argentine growing conditions, an uptick in expectations for biofuel demand in the US, and more aggressive buying by non-biodiesel users than we've seen over the past, really since the holidays. Kind of once the holidays hit, people kind of took off, and they've come back a little bit, but the buying has not been as people are certainly taking a much more wait and see attitude, I think, than they have at other times. And that is in part because basis levels have been kind of continuing to come down. And so you're essentially paid to wait. This is what the forecast looks like over the next 10 days for rainfall in South America. You can see in the main producing region in Argentina, in Mato Grosso do Sul, they're going to get 4.7 inches of rain, or at least they're forecast to get 4.7 inches of rain over the next 10 days, which is about 150% of what they normally get. And on the opposite end of the spectrum, is in the main producing region in Argentina. Over the next 10 days, they're going to get about an inch of rain, which is about 80% of normal. 80% of normal isn't bad, and it's certainly an improvement over what they've seen earlier in the season. And if it is sort of the beginning of a trend or a shift in the trend towards more frequent and steady rainfall, then it's a good thing. And for the farmers down there, it's a good thing no matter what, because they need rain. But it only the 80% is really significant if the ground is already dry. If it's already dry and you get 80% of your expected total or of the average total, again, you get some improvement, but it doesn't really last that long, and it keeps the crops alive, but it doesn't necessarily improve the prospects for yield in the longer term. All right, so speaking of soybean oil basis levels in the US, you can see from the beginning of the first quarter of 2022, we have worked back and eliminated almost all of the rally from that point. So we rallied up 18 cents, and we've come back down. No, that's gotta be. We've come back down we've come back down about 17 cents. Sorry, I was looking at the 8.5 cents and trying to work that out in my head. The refining margin right now is 8.5 cents. And one of the expectations that I've had, that I've talked about on this call before, is that if you think about RBD basis as a composition of crude basis and the refining margin, that the expectation was that crude basis probably would strengthen, the refining margin probably would shrink, and RBD basis would probably move a little bit lower, but not nearly as much as the refining margin. Like a lot of things, that has not necessarily been what's happened. So the crude basis is the only cash price that I track in sort of the US, only major cash price, I guess, that I track in the US that's actually up for the year. At the beginning of the year, crude basis was about 2 cents, and it's about 3.5 now or so. So it's up, but it's up from a really low level, and it's down obviously substantially from the peak. And the refining margin has been stickier than I would have thought. Now, the refining margin has come down certainly from the peak, and it is right around there's a level around 7% or 7 cents that it's kind of bounced off a couple of times. So it's sort of right around that level. But I think that in the longer term, that probably what I've described about the change in crude basis relative to the change in the refining margin will hold true. But right now, what you've seen is that biofuel producers haven't been really aggressive in extending their coverage, and that reduces the demand for crude soybean oil. In addition, there have been issues getting plants up and running at full capacity. And I think at least part of those issues have been related to pretreatment. And so to the extent that there is biomass-based diesel feedstock demand, I don't think it's as much as it will be in the coming months as the plants sort of iron out the problems and get up and running fully. I think they're probably buying a little bit more RBD or refined feedstocks than they will in the long term, just because it's easier to make the plant run if you're sort of removing that pre-treatment stuff. So while that prediction has not worked out in my favor so far this year, I do think by the time we get to the end of the year that probably will be in full effect. But the big question is, where will RBD basis be? I still believe that the market probably is not fully pricing in the feedstock demand, at least that I'm expecting in the second half of the year. And so I think that RBD basis right now probably is about as low as it's going to get. So maybe it can move lower through February and March and maybe into the second quarter. But I think by the time we get to the end of the second quarter, that we probably are going to be in a spot where RBD basis starts to rally. And by the time we get to the end of the year, at least my forecast right now is that basis levels are probably relatively close to where they were last year, RBD basis levels. Now, maybe they'll be a little bit lower, depending on where we sort of start to rally from. But if my theory is kind of correct, I think that this is a good time for people to be extending coverage, or at least to be thinking about it. I mean, if the market continues to kind of move down, you don't want to shoot your shot sort of before the bottom is in. But I think in the longer term, this time will have proven to be a good time to think about covering your basis. All right, so one of the things that I've highlighted over the last month or two has been the soybean oil yield and its impact on production. And I think this will probably be the last time that you'll hear about soybean oil yield for a while. So just bear with me for one more time. The NOPA data indicated that there was a sharp jump in the yield, much larger than you would normally see from November to December. And the yield kind of tends to rise throughout the rest of the year. So USDA confirmed that with their soybean oil production data in the fats and oils report last week. And as a result, we changed our yield forecast to 11.74 pounds per bushel, which increased our production by 125 million pounds. USDA's average yield right now is, I think it's 11.67. Might be a point or two lower than that, but it's somewhere right around there. And I think they are probably going to need to do something similar. This month's report would be the perfect time to do it, but they may do sort of a half raise and then a little bit more and a little bit more over the next several months, because yields can be a little bit volatile. In general, they're not, but they can be. And so USDA tends to take a relatively conservative approach to changes in their balance sheet. And so I don't know that I would expect them to fully raise their yield up to where we are, but they could, and it would make sense, at least from my perspective. Okay, so one of the other keys sort of going forward, I think, is the biodiesel capacity and its feedstock demand. And we've talked a lot about this, about how I believe that the mandates imply capacity utilization for renewable diesel will be lower than the renewable diesel plants will actually run. And so we need to do something to fix that, because they're going to run at capacity utilization rates that are more in line with the historical average than what I believe the mandates imply. And we've talked about sort of, okay, well, there are a couple of different answers to that problem. One of them is to reduce U.S. domestic biodiesel production. This chart kind of shows our expectations for biodiesel production over the balance of the marketing year. And you can see we're basically sort of right on the 5-year average for most of the rest of the year. However, if you compare this year to last year and to the year before that, we're generally above those lines, which doesn't suggest, at least at this point, that the biodiesel capacity is going to be reduced at all. We have seen some very, very minor reductions in the EIA's estimate of U.S. biodiesel capacity, but nothing like would be required to sort of fix the renewable diesel capacity utilization problem. And so I think that there will be some reduction in biodiesel capacity, and I think there probably will be an increase in U.S. biodiesel exports. But I also think we probably are going to build the RIN bank a little bit more in 2023, and that is going to continue to sort of weigh on RINs. Now, RINs have come down, and at some point somebody told me that RIN prices are more correlated with feedstock prices than anything else. And I made the argument that if the spread is relatively narrow in RIN prices, because the market's concerned about the ethanol blend wall, that can tend to support prices. And as I've said on this call over the last several weeks, then the spread between the D4 and the D6 RIN is as narrow as it has been in a very long time, certainly more narrow than it ever was in 2022. That said, and RIN prices have been sort of slowly moving lower, but that sort of started to accelerate this week. Now, I think with today's move in soybean oil, and if this is the beginning of sort of a recovery in soybean oil, not necessarily to 70 cents, but at least a move back up from the lows that we traded at earlier in the week to at least the middle or upper end of the recent trading range. If that happens and RIN prices sort of don't respond to that, then I think that that will make me a little bit more confident in the idea that the biomass-based diesel industry is going to build RINs, and maybe build RINs significantly throughout the year, because that does seem to be one of the effects of this theory, is that if all of that is going to happen, we probably need to lower RIN prices, and maybe lower RIN prices substantially, especially given what we're about to look at here with biodiesel margins where they are. The RIN is probably more important for biodiesel producers than the LCFS credit, just because the bulk of biodiesel production doesn't really get shipped to the California market, although, again, in a couple of minutes, I'll show you it's a really significant difference there. But because of that, the RIN prices probably are pretty critical to whether biodiesel capacity utilization or biodiesel capacity remains around where it is, or we end up shutting down a couple of very small biodiesel producers, or we make a significant reduction in biodiesel capacity. If the RIN market really cracks, then I think that there's a better chance that that biodiesel producers will close their business. Although, again, if you think about the choices that they have after they close their business, or after they decide not to be biodiesel producers anymore, there aren't really any great choices. And so to do that, the market is going to need to convince those producers that margins are going to be negative and stay negative for biodiesel producers for a relatively long time. Okay, so based on kind of that, let's just look at a comparison across feedstocks for biodiesel production that is sold into the California market. Now, again, this represents less than 20% of the total biodiesel volume produced domestically, but it is interesting to see how the various feedstocks sort of stack up. And maybe one of the more surprising things to me is that yellow grease is the most profitable feedstock. Typically, I would think yellow grease, and the way that I tend to think about it is yellow grease and UCO are in one category, and then you have the fats and greases in another category, and then you have the veg oils in another category. And that sort of matches up with their CI scores, but it also kind of, for a while, it sort of could tell you what the relative profitability of the feedstocks would be. But as you can see, it's gotten much closer. Now, soybean oil and canola oil remain at the bottom or near the bottom of profitability for biodiesel producers shipping into California. But that spread has definitely narrowed over the past year, especially for canola oil, which of course suffered from the drought, which is why it had such a problem. But even for soybean oil was sort of treading around zero or just below zero for a significant portion of 2021 and 2022. And now all of them are, if you ship them to California, based on our estimates, before fixed and variable costs, I want to stress that this is just sort of the value created by the feedstocks minus the feedstock cost. So this is the roughest estimate of profitability that there is. But using that formula, it suggests, there is a dollar plus just in the excess value from fuel that the feedstock creates, given the RIN and LCFS credits, the blender's tax credit, and others. Okay, so this is the same chart for renewable diesel, and while some parts of this chart, so yellow, grease, and UCO are the most profitable and are in sort of their own little group, that makes sense. What is really surprising, though, is that if you look at the least profitable, it's distillers corn oil and poultry fat, while soybean oil and canola oil are near the upper end of the sort of the middle group, in line with a lot of the fats and greases. This may be due in part to sort of the idea of CI parity. So I've gotten a lot of questions about whether feedstocks would ultimately trade at CI parity. And my answer kind of always has been that, because not every gallon gets shipped into an LCFS credit market, that until that happens, CI parity is going to be tough. Well, we do ship, the majority of domestic renewable diesel production into the California market. And so while it's not perfect, and while I don't think that we will quite get to CI parity, there is a movement. And I think the consolidation of soybean oil and canola oil with some of the other fats and greases kind of shows that that it may be a possibility when the blender's tax credit expires and turns into an LCFS-like credit. And so then literally every gallon will be impacted by the CI score of the feedstock. And in that case, then I think you might see the spreads start to narrow. The one question that I kind of had when I looked at this chart, oddly, is I thought, well, if you look at the biodiesel profitability and the renewable diesel profitability, shouldn't they be sort of similar? Because they're both going into the same market, same sort of transportation and feedstock costs. There's a little bit of difference in the fuel prices, but in general, that affects all of the feedstocks used in this chart in the same way. And it finally dawned on me that the main difference between this and the biodiesel profitability is in the conversion rates. And so because conversion rates, particularly for fats and greases, are typically lower, it takes more of that fat and grease to make renewable diesel than it does to make biodiesel. That's why you get the diversion. All right, so the last profitability chart we'll look at is a comparison of biodiesel made from soybean oil across several different markets. And when I say that I think it's going to be tough to get biodiesel producers to close down, I'm thinking of this period here from sort of spring of 2021 really on through spring of 2022. So for a whole year, And this again includes credits, but not fixed and variable costs. But for a whole year, it looks like the biodiesel industry was operating at negative margins. Now, let's assume that the margin calculation isn't down to the penny accurate, but that the trend in the margin calculation is accurate. And if we make that assumption and just sort of ignore the numbers, what this chart says is you're going to have to drive biodiesel margins down substantially from where they are right now, and then hold them there for a really, really long time for biodiesel producers to really start to close their plants. And I think that this chart probably more than any other highlights the difficulty in reducing the biodiesel capacity. And so unless or until we get to that point where we really start to do that, I think there is going to be probably always some risk that RIN prices will continue to move lower, and always some risk that feedstock prices will move higher. Now, again, the person that told me that RIN prices and feedstock prices were inexorably linked is generally, I think, right. And so that combination makes it very difficult. It's tough to move RIN prices lower while feedstock prices are going up. And so I think you get one or the other. And because of that, you probably don't get an extreme decrease in biodiesel margins, at least not in the short term. And if you add some states have started to provide incentives for biodiesel use. If you add that in, it just seems to be really challenging to back up the argument that we are going to dramatically reduce biodiesel capacity in the short term. In the longer term, I think it's obvious that that's what will happen. I guess I could create a scenario where it didn't happen. But in the short term, it seems like it's going to be awfully difficult. One thing, and the reason that I put the note here, is that if you look at the difference between sort of the average margin in the other markets in the California market, it's really surprising to me that we don't ship more biodiesel into the California market, especially given it sort of made sense when biodiesel production was so much larger than renewable diesel production. But now that they're about equal, it's surprising that we ship so much more renewable diesel into that market. And the shortfall has driven biodiesel prices, stripped of the credits, above the price of renewable diesel, which doesn't make sense because renewable diesel is generally easier to work with and all of those kinds of things. And so it typically enjoys a premium. But over the last several months, it's been the opposite in the California market. And it's a puzzle to me why more biodiesel producers don't ship their product to the California market. All right, just kind of quickly a preview of the Malaysian palm oil forecast, and I apologize for looking off. There was supposed to be another slide in here, and I forgot to put it in. So the Malaysian Palm Oil Board is going to release its monthly supply and demand estimates on Friday. Expectations for Malaysian palm oil stocks at the end of January are basically unchanged. The median estimate is a less than 1% decrease in stocks from the end of December, but the range was a little wide. So the range was basically from an 80,000 ton decrease in stocks to a 240,000 ton build in stocks, with again the median sort of right on where or close to where December's number was. And the stocks number will be probably the key driver to the market's reaction this month. However, I think that the production number is probably, in terms of the outlook for palm oil in the longer term over the balance of the marketing year, I think it's probably a bit more important, because January tends to set the bottom in the seasonal decline in production, and then production rises throughout the year from there. And you can see we're predicting output of 19.4 million tons for the marketing year. Now, what that means is that the September number, which is sort of my balancing number, is probably a little bit higher than I might like. I might like that, even though the slope of that line is pretty close to the slope of the 5-year average at that point. It's probably just a little bit high. So if I were really, really going to fine tune that forecast, I probably would lower it a little bit. However, I want to see where we end up in January, because again, if it's sort of like soybean oil yields, where once you have that number that you can kind of set the rest of the year on, then you can have a fairly good grasp of where you think yields or production is going to be. And the January production number really is that number. So I'll be very curious to see what the Malaysian Palm Oil Board says the January production is. Outside of that, on exports, what I wrote about this week kind of is that on one hand, you have Indonesia introducing or revisiting the DMO program and the ratio of exports to domestic sales, and also increasing potentially increasing their biodiesel blend. And so that should be positive for Malaysian exports. That should help Malaysian exports, obviously. However, the world's largest importer, India, has this tax holiday for certain vegetable oils, and that is going to continue through at least the end of March. It looks like India is probably going to revert back to the tariffs, the legislated tariffs, after March 31st, but that has on some level been sort of one of the reasons why we kept waiting for India to restock, kept waiting for India to restock, kept waiting for India to restock, and they just sort of weren't doing it. And they've been absent from the market. Now, given the March 31 potential ending, I think that what that means for Malaysian exports, no matter what Indonesia does, is that Indian buyers probably aren't going to do a whole lot before that, if they think that it's going to extend. If they think that it's going to, if they think it's actually going to end on March 31st, which again, that's kind of what it looks like, then maybe it will see an uptick in Indian imports of palm oil. However, we certainly didn't see that in January, and January's total is going to be sharply lower than December's total. Part of that has to do with the seasonality of imports before the Lunar New Year. So there's the January number is always a little bit lower because importing countries stock up, and then people buy oil to cook dinner with their families and celebrate, and then they don't need as much oil in the month that follows. So that part isn't necessarily unusual, and because of that, I don't think that the export number this month will be that important. How exports are going in February and then in March will probably be more important. And the key thing beyond whatever happens in Indonesia will be to see what happens with India. Do buyers scramble to load up on supplies before the end of the favorable import taxes? Or do they wait? The import taxes, while they sort of set taxes, and I think I've got this right. I think they set taxes for crude palm and crude soybean oil and crude sunflower oil, all sort of at the same level, which is zero, but then there are a couple of other little taxes that make it like actually 5.5%. While that should make palm oil more competitive, the decrease in the palm oil tax rate relative to the decrease in the soybean oil and the sunflower oil tax rate is smaller. And so soybean oil and sunflower oil then become, I think, more competitive in that market. And if the preferential treatment is going to end in March, I think you might see, again, people loading up on soybean oil. Palm oil imports remain relatively suppressed, and then after the tax rate goes back to the normal tax rate, then you start to see a pickup in Indian purchases, and especially if Indonesia adjusts the DMO ratio down and raise their biodiesel blend rate. Okay, so that is unfortunately all I have on that. There's one other thing that I just wanted to look at quickly, and that is, given what I said about RINs, I did want to sort of go through and look at our RIN forecast because it changed a bit. I don't know what this is, but this isn't supposed to, the D6 is not supposed to be above the D4 there. So apologize for that. I will have to go back and adjust that. That's what happens when the spread is so narrow. However, the forward outlook is a big change from where I have been, which I had been sort of in the 170, 180 range for much of the year. And this is the first time that that the models wanted to bring prices down, and then I adjusted them even a little bit lower relative to what the models suggested. Now, the other thing to note here is that I've increased the spread in between D4 and D6. If this theory about renewable diesel capacity utilization is correct, then I think that overproduction of biomass-based diesel probably starts to convince the market that whatever the ethanol shortfall is, it's not going to mean that we don't meet the mandate. And I think the spread will widen a bit going into the last quarter. We'll see if that happens. That's not something that I would bet my house on, but it's something that makes sense a little bit intuitively to me, especially if you look out at the HOBO spread and the spread between the price of corn essentially and the price of ethanol. If you look at that, what you see is that essentially the HOBO spread rises up until I think the first quarter of 2024, and then starts to fall, and then the spread between the price of corn and the price of ethanol doesn't follow the same pattern, and kind of in the summer months goes a little bit in the opposite direction. And so it looks like you probably might even produce a little bit more ethanol during that time than you would during the rest of the year. And so that's part of the reason also why I'm predicting that the spread will widen, although not as wide as we saw last year at any point. Okay, with that, we have some questions. Thank you for those. And excuse me for 1 second. Sorry about that. In an earlier forecast, it appeared that when comparing UCO and yellow grease, there was a forecast of a widening spread. In the current model, it seems the spread has narrowed significantly. Why? So I actually went through all the forecasts in a fair amount of detail last night, and because it was the end of the month, and so I look at the forecast every week, but at the end of the month, I have to fill in the average price for the prior month and I really kind of spend some time looking at the forecast. And so if you look at where the spread between UCO and yellow grease has been, it widened out for a while, and then it started to narrow. And last night, as I was looking at it, it seemed that one, the trend towards narrowing, given the profitability, the relative profitability of yellow grease versus UCO, seemed to kind of make sense from just that perspective. Now, I think that probably UCO may be a preferred biofuel feedstock, and so it may not be just straight economics that drive the decision between using yellow grease or UCO, and so it might be a little bit of a red herring, but that's kind of the idea behind the narrowing spread. It is one of the forecasts that I wasn't really super thrilled about. However, one of the ways that I look at the forecast outside of, so we forecast the prices based on fundamentals in that particular market, and then we look at several key spreads between the fats and greases and where those have been, and that UCO yellow grease spread is one of those. But there are other fats and greases that we compare UCO and yellow grease to. And so in addition to that spread sort of needing to fit into the recent trend and the thoughts for what's going to happen in the future and the fundamentals in each market, the spread to other commodities also sort of needs to fit some of those same criteria. And from that perspective, the spreads to the other markets sort of pushed the spread between UCO and yellow grease down a little bit more than I probably would have put it if I was just looking at that spread alone. And that's why I say, of all of the forecasts, that spread is probably one of the ones that I'm not as confident in as I am in others, because it is a little bit, especially relative to recent history, it's a little more narrow than it has been historically, and I'm not quite sure that we're going to get down to the levels in that spread that I'm predicting right now. But again, if you look at it across other commodities, then it all seems to fit. Not that there couldn't be another way that it could fit, but that seems to be what's going on. For the profitability charts, can you just elaborate on which specific credits you're including in those, e.g. is California carbon allowance included? So it's basically just the RIN, the LCFS, the blender's tax credit, and then the carbon tax credit. The carbon tax credit is, and I always forget this, so excuse me for just 1 second. The carbon tax credit applies to or the cap and trade, sorry, the carbon cap and trade credit applies to renewable diesel and not biodiesel, just to be clear. So it's included in the renewable diesel calculation, but it's not included in the biodiesel calculation. And that's it. Those are the only credits we use. And then, like I said, we don't include fixed or variable costs in that calculation. Is the biodiesel capped by the blend wall in California? Is that why biodiesel doesn't ship to California, even though the margins look higher? That very well could be. I haven't looked specifically at that, to be honest with you, but that makes a lot of sense, and it is something that I will look at in detail, and I will follow up with you, because I haven't, and so I don't have an answer, but it does make intuitive sense. but that would be why we don't ship more in, even though there is a big gap in the profitability. Now, while I say that, it does seem like there should be room for more, given the size of California's diesel market. But again, let me look at it, and I'll respond to you directly, and if it's something that's interesting, I'll talk about it on the call. Are the charts that you shared today available on the Jacobson website? Unfortunately, they are generally not. The Jacobson website is essentially frozen in time right now because of the acquisition by Euromoney, and then the acquisition of Euromoney by the private equity group. We are going to move to a platform that will have not only, I think, all of these charts, but I think will allow you to create any charts that you want. Basically, I think it'll have all of my data in it, so that you can download almost any of my data, and there will be some charts that are suggested, but I think it will also have the capacity to allow you to make your own charts that you find more interesting than mine. If you ever want any of the charts or any of the data that you see on this webinar, or that I talk about, or you just have a question, one, I probably have the data, and two, I am generally happy to share it with you if you ask me. There will be some times that I may say no. There are some things that we don't share, primarily because we don't want to reveal things that would that other companies wouldn't want us to reveal. So one of the things that we typically don't share are sort of some capacity numbers, that kind of thing. Now, for biodiesel and renewable diesel, those numbers are generally announced when the plants are built. Once you get into the crushing industry, it's a little bit different. And while they will announce those capacities, while they'll announce crushing capacities, they don't really like to talk about refining vegetable oil refining capacity and that kind of stuff. And so we tend to not release that, and or if we do release capacity kind of data, then we group it in a way that doesn't reveal the individual capacities at specific companies. So I bring that up only as an example of something that I wouldn't probably share. There are other things and other reasons that we might not share something, but generally, if you ask me, I'm happy to share at least the chart with you, and probably the data behind the chart as well. So send me an email, and I will be happy to send that along. Despite the acquisition process, the forecasts are still regularly updated on the Jacobson website, right? Yes. So when I said frozen in time, I didn't mean the data. I just meant the sort of the structure of it. So the data gets updated every week, but creating new charts or taking charts down doesn't we can't change that stuff. One other thing that I will note is that I just noticed, and this is horrible on my part, and I apologize for it. I just noticed how out of date some of the charts have been. So I've worked through vegetable oil, and I think those are now all up to date. And I'm going to start on biodiesel, on the biodiesel charts. And I think that on the fundamental charts, like the whatever production and stocks and those kind of charts, I think those will be updated before before next week's webinar. And I apologize about that. I thought that I had sort of run those out for quite a while. And as I kind of looked into them last night, I realized that I hadn't really. There's a spreadsheet that sits between, and you don't want to know this detail, but there's a spreadsheet that sits between spreadsheets I work in and the charts. And so I link that to the spreadsheet that I work on. What that means is I don't really have to look at that middle spreadsheet every week. I just open it, save it, and close it. And again, time goes by really fast, and I didn't realize how out of date some of those charts had gotten. So I'm going to make sure all of the charts are updated going forward, and then yes, the forecasts get updated on a weekly basis. And if you ever have any questions, need anything, or have a specific question about a forecast, please always feel free to reach out. All right. All right, that is it. I appreciate everybody joining me this week, and look forward to seeing you all next week. I hope everybody has a great week, and I will see you next week. Bye-bye.